Looking back over the last decade and a half, the financial markets have experienced remarkable expansion, particularly in the decade following the global financial crisis. In the end, the stock market had one of its greatest decades in nearly 140 years. Without a doubt, cheap money was a major driver for this remarkable expansion, as the highest interest rate at the time was 25% in 2019. As a result, it has become easier and less expensive to acquire money, making it easier for businesses to expand, investors to make more money, and valuation to rise by the end of 2019. It was believed that whatever one purchased would quickly double in value, so the market collapsed. But this time, it was a pandemic, and the record decade-long run ended. Investors' enthusiasm began to wane, and they began withdrawing their funds from the stock market. The pandemic threw the world into chaos. Businesses were closed and financial markets crashed. The recession was severe, and the investment world was brought to its knees. Central banks around the world began creating money to assist their governments in covering some of their pandemic-related expenses. Similarly, the US Federal Reserve produced trillions of dollars, which were eventually pumped into the economy in the form of stimulus checks, rescue packages, and so on. But free money couldn't save US citizens. These debts inflated the economy, and the United States had to experience a 40-year high inflation rate in June of this year. And now, we are dealing with decades-high inflation, with everything becoming out of reach. The United States Federal Reserve has once more intervened in the market and begun to increase interest rates. However, the effect of this move has been disastrous. This increase has made it harder for businesses and consumers to obtain credit. These harsh steps have stalled the economy, with panic extending to financial markets, including a plunge in cryptocurrencies, for example. Businesses are struggling. The real estate sector is in decline, as is the equity market. A major sell-off from investors can be seen in the aftermath of fears that the world is on the verge of a terrible recession. But for the investors, what's the right time to enter the market? When the markets are already at their peak, or when everything's on sale in the investors' world. It is a well-known fact that crashes are the best time to become rich, and crashes don't happen often, so no one can predict with certainty that people will experience another period in their lives when everything will be on sale. But the question remains, is now the ideal moment to accumulate wealth? Is this the right time? And if so, how can one take advantage of it? If you're going to do stupid things because of your stock falls in value, you shouldn't own any stock at all. Investing involves complex psychology. The basic concept of investing is to buy low and sell high. But most people, on the other hand, do the opposite. They buy high and then sell low. The reality is that they don't need to do this, but when circumstances are rough, uncertainty and fear make people do crazy things. Legends like Warren Buffett, Charlie Munger, Guy Spear, Phil Town, and others, on the other hand, say that when the market is severely down, it is an excellent moment to invest. This is a fascinating phenomenon. The fundamental reason for this regressive mindset is that people do not appear to have clear investment objectives. They typically do not commit to a long-term investment time horizon. As a result, when things go bad and a recession comes, instead of seizing the opportunity, people flee the short-term chaos, which is a terrible strategy. Experts say people should wish for the stock market to fall. They should desire to buy at a cheaper price, but they have the impression that they feel better when stocks are rising. Since 1926, the United States has had 11 bear markets and 15 recessions. If we include the pandemic plunge in 2020, the total number of bear markets would be 12. But if you invested during these terrifying times, you were rewarded. For example, after the Great Depression, returns were roughly 265% over 44 years. People who invested in the most recent bear market saw 20 to 50% returns in a span of 12 months. Even though there's no perfect market in which to invest, these trends indicate that bear markets offer excellent possibilities. In fact, you would have made a 9% return if you had bought at the peak right before the 2020 COVID epidemic. If you had invested at the market lows, which were a few weeks following the top, you would have made 60%. This is how an entry point differentiates itself. However, keep in mind that such large drops are uncommon. With 147 years of bear market and 754 years of bull market, it can be argued that recessions are excellent times to invest. But how do you take advantage of this opportunity without stumbling? 1. Stay current with what's going on in the market so you know when these opportunities may arise. And 2. Execute your strategy appropriately, whether actively or passively. When there is a market downturn, we all know there are two things to do. Long-term investment is either dollar cost averaging or Warren Buffett style, which is long-term value investing. Most people now use dollar cost averaging. This approach provides a long-term benefit to the investor. This method does not appear to rely on market timing or snatching a market crash chance, but it is. This is straightforward. You buy more equities when they are lower and fewer stocks when they are higher. This is entirely natural and the most effective technique for passive investors to capitalize on the opportunity. So the question is, how do we determine if a company will survive such adversity? The company you're considering must have pricing power. This indicates that they have attained a competitive position. They can raise prices without experiencing a decline in sales. Many businesses, for example, are lowering their prices as consumers spend less on discretionary items. Coca-Cola, on the other hand, is large enough that it can raise prices without experiencing a decline in sales. During an inflationary environment, when companies coax prices up, they can pass the cost on to consumers without suffering. Last but not least, you must determine which business model you are adapting. Will it be able to do well in a rough economy, like grocery stores which do well with similar models during recessions? This is due to people's inability to stop purchasing necessities such as insurance and airline tickets. All of these are items that people can't seem to get enough of. As a result, active investors must consider business strategies, pricing, power, and debt levels, whereas passive investors must focus on holding on for a long time without letting fear, uncertainty, or doubt move them. This has been yet another informative video for all of us, and we hope you learned something. We can't wait to tell you more. Please subscribe and hit the like button. Thanks!